Hey everybody, John King with Summit Funding. It is Friday, the 21st of March. Here I am with my weekly update, and there is a lot going on this week. The Federal Reserve met. We've got more tariff tug-of-wars going on, and interest rates are moving. So let's dive in and get started. So first of all, tariffs are a double-edged sword. I've been talking about this, but I want to be super clear. Tariffs are in some ways really, really bad news. They can lead to significant inflation. Tariffs can obviously make things more expensive for everybody. The second side of it with tariffs is that tariffs are long-term supposed to make better, stronger economy within the United States. Whether that's going to happen or not, nobody really knows. But it's a big tug of war right now, and it was front and center on Wednesday when the Federal Reserve met. They did their press conference with Jerome Powell Wednesday afternoon, and the Fed meeting was really, really important. We saw interest rates drop pretty significantly as a result of the Fed meeting. Now, significantly in my world is like they moved this much, and that's a really big deal. So we saw an improvement this week, and it's moving in the right direction. Why? Well, there's a couple of things going on. First of all, the Federal Reserve says every time they have a press conference, they tell us what are they projecting for the rest of this year, next year, in the long-term future for rates to be. And they projected the same thing this month as they projected back in December. But the market reacted in a very positive way. And the reason why is because there's something called QT, quantitative tightening. Big word. Here's what it means. It means the Federal Reserve had for years purchased treasury bonds and mortgage bonds, and that was called quantitative easing. Now they've been doing the opposite for the last few years, and they've been tightening by not selling, but letting that when those bonds are paid off, they won't repurchase using the money they get in the payoff. And now they're saying, hey, we're going to slow down that tightening. They're not going to let as much of those investments disappear. Now, what does that really mean? I can get into the whole complicated piece, but what it means is the Fed's actually showing their concern about the economy weakening. And that is the issue right now, is inflation and the economy and the jobs market. And it's being driven a lot by tariffs. And so in the short term, there's a lot of concern about the pain that is going to happen in the economy. You've got the president, you've got his cabinet members, you've got the Treasury Secretary, all talking about the pain that is likely to be felt. Kind of like when you start working out, you start getting the core muscles building, and you start feeling pain because, well, you hadn't been working out those muscles. Now, again, I don't know whether you think this is a good idea or not, and I'm not debating whether it's a good idea or not. The president thinks it is, and whether it works or not, we'll see. But the fact of the matter is there's going to be pain in the meantime. No different than if you're smoking and then you stop smoking, you're going to have some withdrawal symptoms. So there's a lot of concern about what's going to happen to the economy in the short term. And the Fed agreed. They didn't say it, but their actions agreed because they reduced the squeeze they were putting on the economy because they thought the economy was way too hot and inflation was going way too high. And so they were going to put a squeeze on another part of the economy, which was through their technique of quantitative tightening. And they're releasing that squeeze a little bit. That's a sign the Fed thinks that the economy is likely to start slowing down. Well, what does that ultimately lead to? A major concern right now of something called stagflation. I've talked about this before. Stagflation, stagnation, meaning slow down in the economy and in the GDP, the economic output. Fewer jobs, fewer workers, fewer goods and services produced in the economy. So that's the stag part. Inflation is inflation. So it says, okay, so normally if you have inflation, it's because everything is going good and the economy is doing really good, and therefore the price of everything is really high. That's kind of what happened over the last few years. We had high inflation because everything was going well, and so those two happen at the same time. Then you normally have, if you have a recession where the economy is slowing down, you also have low inflation because the economy is slowing down, people aren't buying things, and so therefore the prices are not going up. Stagflation is when the two opposite things happen at the same time. You have prices going up while you have the economy slowing down. And what the Federal Reserve is saying is, we actually aren't worried about this like we were in the 70s. This is a different type of stagflation. This is more transitory. They used the word transitory. Jerome Powell said transitory. Why does that matter? Because in 2022, Jerome Powell called inflation transitory. He said, this inflation's not here to stay. It's just because of the supply chain that happened because of COVID. And so the inflation issue is going to go away and we'll be just fine. Well, right now he's saying these tariffs, the problems that the tariffs are leading to, the stagflation that we think we're going to have, he didn't use the word stagflation, but that's transitory. The inflationary concerns that are coming from the tariffs, that's transitory. I'm not worried about that inflation being long-term, but his actions show that he is worried about deflation, is worried about economic slowdowns. Okay, so I've got a comment here. In reality says, if they do QE, it might still drive home prices up. No, shouldn't they stay tight and either raise or keep rates as is? Yes, I agree with you. It's funny. I've been listening to a few different podcasts recently who have basically have a perspective, and I don't disagree with it, that the average American has a majority of their wealth in their home. And the economies, the government, the political environment that we've been in for years has propagated that we have said, look, this is a good thing. We want people to save money and their home is the best place. And it is. The single largest source of most people's wealth is in their home. But that means that if people don't feel like they're winning, they're not likely to vote in the people who are currently in office. And the way they put this together really made a lot of sense. And it goes to your point right here, which is the elected officials want you to feel good about yourself. Well, how do you feel good about yourself? By doing better today than you did yesterday. That means you got a little bit better job. You got a little bit better income. You got a little bit more money in the bank. You feel better about yourself and your life, even if it's just a little bit. They need to keep home prices up. They need to keep home prices up. Because now there's a cleanse, but the problem is cleansing of the economy is a recession, but recessions historically drive home prices up as well. So you've had very few times when home prices have significantly dropped. We're not going to see affordability fixed by home prices going down. We're going to see affordability fixed by seeing incomes come up over time, because what we had a really long time. We were spoiled for the last 15 years. Now, maybe 2010 to 2022. We were spoiled because we had significant increases in our raises, regular increases in our income, yet we didn't have almost any inflation and it was super cheap to borrow money. And so our expectation of affordability has actually shifted. And we think, well, man, I should be able to do all of these things and go to Disneyland and go to wherever I want to go and do everything I want to do, because I've been able to for the last decade. And we have to wait now because I don't think home prices are going to come down. We're going to see undulations. We see them in different regions. Austin, Texas is a region where home prices have come down. Florida is having a correction, especially in condominiums. I'm going to talk in a few minutes about condominiums. It's a bigger issue than even I've been talking about. But the truth is, you're right. You're 100% correct that it will drive home prices up if they slow up the quantitative tightening. And if the goal is to lower prices, then you're right, they should stay tight and raise rates. But I don't think that's anybody's goal. I really, really don't. And so I'm not going to camp on this anymore, but I love the comment. And I just think that you're right, but nobody wants you to be right. And the truth is, every homeowner says, I don't want my home price to drop. And so how do you make something more affordable? Well, you lower rates so it's perceived to be more affordable. That's one thing. That's what Trump is absolutely pushing for, is lower interest rates. There is a perception of greater affordability when rates are lower, even though prices end up being higher. And so it's a trade-off, okay? But the reality is, the only way that we're going to see better affordability is having more houses built so that prices don't go up. We want to add supply. That is one of the things that the administration is talking about, is taking federal land and allocating it to build homes on federal land. I'm not sure if that's going to work or not. I'm not sure the regions of where they're talking about, whether that's even going to be viable. It's not like you can build homes in Oklahoma to solve the housing crisis in California. Like, it doesn't really work that way. So the challenge is, how do we solve affordability? And it comes with time. It simply comes with having enough time for our incomes to go up, for hopefully inflation to kind of stay down a little bit and for us to be able to afford more because we make more. And that's going to take some time. So that's kind of my take on that piece of it. All right, now let's jump back into where I was. So talking about the recap of the Fed meeting, here's the final outcome. Okay. Oh, we were on the stagflation issue. The final thing is that this whole challenge right now also includes another wild card, and that's the stock market. So the stock market is highly volatile right now. We've seen, some stocks like Tesla that's getting hammered. There's obviously reasons that have to do with the person who runs Tesla, and I won't even touch that issue. But the fact is the stock market, there is a correction happening in the stock market right now. Correction is defined as greater than a 10% drop. We've hit a greater than a 10% drop. There's an argument that says this is going to perpetuate or get worse. There's an argument that says that it's not. But here's the deal. There's actually multiple paths. I said there's two paths. There's multiple paths to lower interest rates right now. I'm kind of excited by this. So first of all, the path that I hadn't been thinking about when I said there were two paths is that bad news for the stock market is good news for mortgage rates. As people have money in the stock market and they start freaking out thinking, oh my gosh, the stock market's not doing well. Where am I going to put it? Well, in the last month, we've seen more people put their money into international stocks, overseas, European stocks, because they don't have the same trade war issues that we're dealing with here in the United States. So there's an argument that there's money going over there, but the more likely place that money goes is into the bond market. And bonds, mortgages are bonds. 10-year treasuries are bonds. Those are loans that are being borrowed by consumers for mortgages, by the government for a 10-year treasury. And when you look at bond rates are mostly tied to attracting buyers, attracting investors. And so if you've got a bunch of people saying, I want to buy bonds because it's safe, then I don't need to give them that big of a rate of return. I can actually lower the rates that I'm giving them because a bunch of people want me to borrow money from them. If very few people want me to borrow money from them, then I've got to entice them by paying higher rates in order to get them to loan me the money. So supply and demand of money is driving interest rates. And when the stock market does bad, that money often moves into bonds that are considered safe, and that lowers the rates on the bond market, which lowers mortgage rates. So that's one of the reasons that we're seeing right now that interest rates are coming down. There was a great article in the last week on the Wall Street Journal that talked about the two reasons why you will see why you'll see the Fed lower interest rates. Okay, so what I talked about a second ago was the market itself and influencing bond markets. What I'm talking about now is the Fed. The Fed does not control mortgage rates, but the Fed absolutely influences it. The Fed absolutely has some strings that they pull that influence the market, and the mortgage rates follow very closely behind. So why am I saying that? Because there's two reasons, a good reason and a bad reason why the Fed will start lowering rates again. The good reason is if inflation actually starts coming back down. So we're seeing tariffs push inflation up. You've got the Fed saying, hey, we're worried about this, but we think that inflation from tariffs is transitory. I said that earlier in this live stream. And so now you've got the balancing act that says, well, if inflation starts coming back down, the Fed can actually start lowering rates again, just like they did in September and November and December, of 2024. So that's why the Fed lowered rates, because they saw inflation coming down, and they stopped lowering rates because they saw inflation start coming back up. But the bad reason, so the Fed will lower interest rates if inflation is coming down. The bad reason why Fed would lower interest rates is if the economy heads into a recession. The Fed, when the economy heads into a recession, the Fed needs to try to send the economy a lifeline. And so if you think about a recession, it simply means companies and people are not spending money. Well, how do you get people to spend more money? You make money cheaper. And so they're going to lower interest rates, just like they do every time we've hit a recession in history. In the last 100 years of recorded history, every time we hit a recession, the Fed has lowered interest rates. Okay, the pattern is there, and we're seeing it play out again. So we've got multiple arguments for why interest rates are going to go down. The big question, when and how much? Nobody knows. Nobody knows. I'm arguing right now to say there's 3 good reasons why interest rates could go down, and they might not change at all for the next 6, 12, 24 months. But the facts remain that there are 3 major reasons why we see the likelihood of interest rates coming down. And the truth is, interest rates don't have to come down a whole lot in order for it to really spark the market. We've seen last year in September, August, September, we saw interest rates dipping below 5% range, and the market was crazy. Refinances all over the place. Everybody's looking to, hey, how can I consolidate that debt that I've run up, and how do I find a home to buy? Because I've been waiting until rates come down, and I'm done waiting. I'm tired of waiting. And now they kind of went back into hibernation again because rates shot back up, but they're now coming back down. We're seeing rates in the mid to low 6s in a lot of cases. In some cases, we're tickling the high 5s. So we're seeing interest rates come back down. It's just about stability. If they can stay in the low 6s to high 5s, we're going to see a very, very busy spring buying market. I'm already seeing it. I'm already very busy right now. I'm happily busy, but never too busy to help you. So don't think that you can't give me a call and let me give you a hand. But the fact of the matter is, the market is taking off already. And there's a lot of arguments that say we're going to see rates coming down even more. The question becomes, what do you do about it? What are you going to do about it? How are you going to take action? Or do you sit back and wait? Do you sit back and wonder, is now the right time or not? The more you wonder, the more you're confident you missed it. Because over time, all of your wondering caused you to miss an opportunity. And I'm not saying that we're going to see rates dropping anytime soon for sure. I'm telling you that there are multiple signs and arguments saying rates will drop. Okay, there's a big argument for a recession. There are concerns about the tariffs and what they're going to do short-term and long-term. And you have the stock market that is feeling the pain of all of those things. So these are all very, very important things for us to be paying attention to. In reality, again, asking a question about Dream for All. So I will get to that in a couple of minutes. I thought you had a question about what I was talking about. No worries. Happy to answer any questions, but I do want to quickly finish a couple of things. 2 topics, and then I'll get on to any Q&A that you guys have. First thing, the Wall Street Journal on Tuesday put out an article that talked about the secret blacklist the government is hiding from you that's costing condominium owners thousands of dollars. It was a great headline, absolutely fantastic. It wasn't really what it was painted out to be. Okay, this secret blacklist is really simply Fannie Mae's list called CPM, or Condo Project Manager. And there's major problems with condominiums right now. I've talked about it on I had an entire video on it on my YouTube channels. Check it out. There's major problems with condos right now. California and Florida are having major issues, especially with recent laws that came into play after the Surfside condominium complex collapsed in Florida. And now you've got a lot of people who have condominiums that are hard to sell because there's some structural problems, especially in California and Florida. Balconies, elevated elements, staircases, etc. They're worried about the structural integrity. There was a huge condominium boom in the 70s and 80s. These properties are 50 years old. And the truth is, look, you buy a condominium, it's great. Condos are great overall. They're more affordable typically than single family residences. But here's the challenge with condominiums. The challenge is you're part of an entire group of voters that are all of the homeowners, and those homeowners want to keep their dues as low as possible. So they will do everything they can to defer the maintenance, to kick the can, to find a reason later to pay for the work that needs to get done. That's creating major problems. So if you own a condo, if you are thinking about buying a condo, just recognize there are challenges right now in the condo market, and the age of those condominium buildings are creating a bigger issue because everybody has postponed the maintenance in a lot of cases. All right, last thing I want to talk about is a success story. I am actually having a lot of buyers and investors having huge success in Tennessee and Arkansas. There's a couple of markets within Tennessee and Arkansas that I have had multiple buyers buy into. They're doing what's called a 1031 exchange. They're selling the property that they have, like in a couple of cases, they're selling properties in California. They're buying properties in Tennessee and Arkansas, and the cash flow is significantly better. Significantly better. You're in a position where you're actually making positive cash flow from the start. and there's upward movement in home prices in those markets. So if you've thought about owning an investment property, it's a good time to jump in and think about that. Now, I'm not telling you where the market's going to go. I can't. Nobody can predict. But what I will tell you is, and I'm trying to find really quickly here. Here we go. So why did I not hit that? What happened? What happened? There we go. Okay, it keeps coming and disappearing. All right, so I have started a channel and a website called Can I Landlord? And I'm really focusing on helping educate people on, can I become a landlord? Is that something that's a good idea for me? Long-term, short-term, it's a different way to build wealth over time. You've got different tax benefits that you get through owning investment properties. You can exchange investment properties for one for another that you can't do with stocks. Like you buy a stock and that stock goes up and you want to sell it and buy something else that has a better opportunity to go up, you're paying taxes on that the minute you sell it. Versus on a property, you can buy a property that goes up in value. You can sell it to buy something else you think will do a better job of going up in value, and you pay no taxes on that because you're exchanging it. That's a simple example of where buying investment properties and investing in real estate is a good alternative, not to put all of your investments, but it's a good play, especially with the stock market having some wonkiness going on here and the unknowns of what's happening in the future. I have some clients that are having good success with that. And I just want to make it clear to you that if that's something you have thought about, I would love the opportunity to talk to you about that. You can scan this QR code right up here. All right, so I'm going to dive into questions, and I have one from In Reality. If you have any questions right now and you're watching live, feel free to post those questions. If you're watching recorded, I'll come back and post or comment afterwards. So your question is, any Dream for All updates? They should be reissuing soon. I agree. So here's what's happening. We've got, I said this a week or two ago, I heard through the grapevine that CalHFA is getting close to wrapping up. They're getting close to shutting off the issuance of new vouchers. They've issued a significantly greater number of vouchers than what they have money for. I'm not worried about them honoring the vouchers, but they're at some point going to cut it off. They don't want this to last forever. I do not have an answer on the date. Like nobody is giving a date. I had somebody who just got a voucher yesterday in LA County, I think. So they're still issuing vouchers. So that's good news because I hadn't heard anybody getting vouchers in the last week or two. So I was getting a little concerned that they had completely shut off the spigot. But I am nervous that I'm not hearing very many new people get vouchers. But for sure, we got to think about the anniversary dates of when people got their vouchers. And so we had people get their vouchers. The first set was June 26th, June 28th, right about there. So those expired at the end of September. Some people, they just expired flat out. Plus, CalHFA issued a bunch more vouchers in the first week of October. I don't know if you remember that, but the number of vouchers went up significantly the first week of October, in large part because that's when they realized, we're setting aside $150,000 per person, and they're not all using $150,000. So those people that got their vouchers at the end of September, the first week of October, their 6 months are about to be up. So you have a big contingency of people who are about to lose their voucher at the end of this month. Hopefully, CalHFA doesn't shut it off before then, but I think there's a big opportunity for more vouchers to get picked up at that point in time. The question is, are they going to issue a one-to-one? Okay, well, we had one voucher that expired. We're going to issue one more, or are they going to be a little more cautious about that? It's hard to say because they already over-vouchered. And so are they going to want to, they were already counting on a certain percentage of those people not succeeding. And so does that open up more or not? It's really hard to say. And I'm always interested if you guys get a voucher, you hear somebody who got a voucher, please let me know because I want to pay attention to kind of what the activity is. All right. Zakun has a question. Do I think today's rate is good to lock or should I wait until next week? I left my wallet upstairs. My coins aren't with me. That's a joke, but I will tell you for sure, my answer is always the same. Are you a gambler? How important is it to you to have confidence of what the rates are versus be risking that, hey, I'm trying to nail this perfectly and time it, and it could go my way and it could not go my way. And that's a lot of stress and anxiety. Is that really worth it to you? Like what you're trying to do, you're trying to take a 30-year mortgage and figure out, well, how can I save the most amount of money in 30 years when I have a couple of days of time to make a decision? There are too many things happening in the economy right now for us to gamble, in my opinion. Now, if it is the difference between you qualifying or not qualifying, I actually think it's even more important. I've had people who it's like, hey, I had a client, Dream for All buyer in January that locked at 7.375. My highest Dream for All buyer, 7.375. And it had just gone up to 7.375. And I said, look, your qualification stopped at 7.25. You actually have to pay to buy down your interest rate to get back to qualifying. And if it goes worse, it's going to cost you more money out of your pocket. Are you willing to take that risk? Now, I know I'm not giving you the answer that you want. I can't. Like right now, what I'll tell you, there's an old adage, never lock on a Friday. If you're thinking of locking on a Friday, always wait until a Monday. I can show you 100 examples where that isn't true. I can show you 100 examples where it is. What we have is a huge amount of volatility. What we have is a president and an administration that is also highly volatile. And so we're not even dealing with an agenda that we can predict. And we've got the impending additional tariffs that are supposed to happen on April 2nd. Now, I know we're 2 weeks away, week and a half away from that. But Zakun, I got to tell you, I'm not a fan of waiting because it's just like buying a stock. When you decide that that stock is a good buy, should you wait until tomorrow or the next day to buy the stock? In the long term, who cares? The movement was this much. I'll tell you a quick story. I bought the house that I'm in right now in 2021. And rates had ticked up. Rates had been between 2.5% and 3% all of 2020, the first part of 2021. And when I bought this house, rates had ticked up and I got a 3.25% interest rate. And I was angry because here I am, I'm in the industry. I got an employee discount. I was at a 3.25% rate and I'd been locking people all along at 2.5% to 3%. And I asked my wonderful wife and I said, hey, babe, I'm not sure. Maybe I should wait until next week to lock our interest rate. It popped up to 3.25%. And my wife was really clear that, look, we're not going to deal with that stress. What if it goes to 3.5? What if it goes to 3.75? And I said, what if it goes to 2.75? And she goes, I'm not willing to take that stress and I'm not willing to take that risk. Now, here's the second part of that story. Nobody feels bad for me having 3.25% right now. Nobody does. You're like, oh my God, John, how can you tell that story? That's a great interest rate. But in the moment, it felt like I had made the wrong decision locking when I did. A month later, the rate was back down to 2.75, but I didn't have a month to wait because I was in contract for my home. I love my home. I'm happy with my rate. The truth is you're going to be unhappy with your rate no matter when you locked. Because at some point in the future, rates are going to be back down to 5%. And you're going to be like, I'm unhappy because I have 6.5. I'm unhappy because I have 6.25. I'm happy that I have 3.25. Like I would be happy if I had 2.75. So you got to think bigger picture. I know I'm on my soapbox. I'm sorry. Hopefully that was still worthwhile. In reality, says wife is always right. Totally agree. She's probably watching. So wife, you are always right. Thank you. And I love you. All right. Okay. And Zakun says, I'm right. I am. More importantly, my wife is right. Okay. So in reality said, am I seeing people do 15 years instead of 30 and paying it down twice as fast? I'm actually doing a stupid, crazy number of home equity loans and lines of credit right now. Obviously, I'm selling myself here. So I'll say I've got a very, very great product that allows you to pull equity out of your home. Super simple, literally getting you approved in like 3 days, 2 days, and you get your money a week and a half later. Very good, attractive interest rates. But I'm finding a lot of people I'm recommending on that do the 15-year. Because when you're pulling out $50,000, $75,000, $100,000 out of your home as a second mortgage and your rate's at 9%, well, first of all, you get a little better interest rate on the 15, but secondly, you actually aren't paying that much extra per month to pay it off in half the time. Now, when you're buying a $500,000 or $600,000 home, I'm seeing nobody or more. I'm not seeing many people doing 15-year loans right now. It's just affordability is too difficult. Affordability right now is too difficult. But for my homeowners who are dealing with debt, you know who you are. You're dealing with debt. Okay, so I'm going to do my paid political announcement right up here. I'm going to switch to this guy. Are you going to switch for me? Yep. All right. So this is my channel about can I refi? You can go here and check out that fast home equity line of credit option or look at options for does refinancing make sense? But here's the deal. If you're borrowing a small amount of money and you're paying small relative to what you owe on your primary mortgage and you're paying off credit card debt that's already at 22 or 25%, go with the 15-year. You're still saving a bunch of money over what you were paying in interest on your credit cards. You're now making it tax deductible. You're getting some money in your hand to do those home improvements that you've been postponing because you didn't know where to get the money from, because interest rates on credit cards and your credit card debt has skyrocketed. Put all of that together and not put it out for 30 years. That's the key. Now, don't tell yourself you're going to pay it off in 5. Nobody does. But realistically, if your difference between $750 a month or $910 a month, go with the $910 because you're already spending $1,500 a month on your credit card minimum payments. Man, I am on soapboxes today. Hopefully this is good information, guys. I have got to run here in a minute. Let's see if I have any other questions. It does not look like I do. Hey, everybody, I really, really appreciate you joining me today. If there's anything I can do for you down the road, please don't hesitate. I am for sure interviewing to be your lender. Oh, Lee had a question really quickly. Just want to say you're the best. You've been incredibly helpful for a year now. Thank you. Thank you. I didn't read it before I clicked it, but I'm glad that I did. Thank you very much, everybody. Have an absolutely wonderful weekend, and we'll talk to you soon. Bye-bye.